we go. Final hour trading in what has been a very volatile week. Joining us in today's closing bell exchange, Danny Hughes from Divine Capital. Patty Edwards, congratulations to the Seahawks. She's with U.S. Bank. You're welcome. Eric Ristebin from Russell Investments. Ken Mahoney from Mahoney Asset Management. Paul Dietrich from Fairfax Global. And, of course, our own Rick Santelli. Patty Edwards, you're a savvy trader. What is the message of the markets today? Why is it able to mount a rally on such seemingly anemic jobs numbers today? What's it telling us?
You know, I think what people are finally coming down to is the fact that the market actually trades on earnings. And earnings have not been that bad. They have not been phenomenal, and we have had some serious missteps. But earnings in general have been pretty good.
So we're all talking about jobs, and the market's thinking about earnings today.
You know, the jobs actually do make a difference, but if you look at the underlying numbers in there, manufacturing was up twice what was expected, maybe even a little bit more than that. And the disappointments were not in areas that you would have expected to see them. So you would have expected that retail would be weak. You would expect that the government would be weak. You would expect that construction would be strong. We saw all that.
You know, Ken, a lot of people now looking at the action yesterday, surprised that we're still holding up okay today, that it wasn't more of a high bar disappointment kind of story. What do you think's really going on here?
Yeah, I think the market kind of likes the numbers in a weird way that maybe tapering gets pushed off. And I recall being on the set the second trading day of the year, and I noticed how investors are so giddy about the market, like it was their birthright to make money in stocks.
Right.
And we see how quickly that changed. I mean, you know, the sentiment changed from this kind of euphoria to now worry, and investors are kind of wrestling with a lot of worries here.
But to be clear, you're saying that you think the positive reaction is actually sort of a bad news phenomenon. In other words, that it's weak and the Fed's going to have to do more, because that's not, I mean, that's a pretty strong view.
Yeah, at this point, they're kind of discounting a lot going forward. In the end, I agree with your other guests that earnings are going to eke out, and that's where people should focus on. The economy having strong footing, and earnings actually having decent growth, and that's where the action is going to be.
Is the economy good enough or not good enough?
It's right back to that kind of not too hot, not too cold, that kind of Goldie Locks where, you know what, we're running around that 2.5% GDP. Maybe the taper will slow down a tad. You know, it's kind of in that, you know, in that kind of Goldie Locks environment.
Eric Ristebin, you're with Russell Investments. The Russell 2000 was near the 10% correction level earlier this week. Now we get this rally here. Is the correction over? Is this it for now, do you think?
Well, I think you have to understand that the market coming into this year was a lot more optimistic about the economic environment we're going to see this year than the last couple of years. I think you're going to see a lot of volatility based on economic data that comes in that disappoints. I don't know if the correction is over, but I suspect that the market tendency is up. Because of the strong economy that we're seeing in the U.S. and none of the economic data we've seen globally is pushing us off of a 3% growth rate in the U.S., 3.5% globally.
Danny, does that mean the correction has run its course here?
No way. I think we're going to have a lot more volatility, Kelly. And I think it's because, you know, from a global perspective, some countries are actually tapering, like the U.S. and Brazil. And then you've got Japan that's actually loosening. So you've got that, and then you've got earnings. And earnings actually have been really good, to Patty's point. But historically, profit margins are 70% higher than they've ever been before. That's not really sustainable over the long term. So I think we're going to see a little bit of a churn over the rest of the course of the first half. But that doesn't mean that we can't come out very well from a corporate perspective. But good news is bad news, and bad news is good news. So it's really, you got to kind of flip it on its head in order to really trade it.
Danny, I'm going to pick on you just because you're on camera right now. If earnings are that good, then why aren't corporations doing more hiring?
For a couple of reasons. What's their incentive? Number one, the government and legislation has not been there to really push it to corporations to incentivize them to hire. Secondly, it's very expensive to hire and fire, and the healthcare rules have not helped that at all. So there's a lot of reasons why corporations have become more efficient and are holding on to that cash and not hiring like they used to.
I wanted to get Paul into this conversation as well. Paul, so what is the verdict from markets today? Are we in a bad news is good news period or not? Because frankly, it seems like the benefit of the doubt here is what investors are giving this jobs report, giving this market, saying, you know what, maybe it's good enough, and not necessarily expecting anything more from the Fed. What do you think?
I think you have to make a distinction. The economy is doing well. Corporate fundamentals are actually doing well, but we have a jobless recovery, and you have to look at three trends. The first trend in joblessness is that as the unemployment rate has gone down over the last 6 months, as much because of labor participation, people dropping out of the market, as we're growing jobs. And that's going to continue because we have 3% of the population retiring as baby boomers, and we only have 1% population growth. The second thing is that we basically have higher productivity. According to Thomson Reuters, we have 9.2% earnings growth for the fourth quarter that beats most analyst estimates. So companies are doing really well with fewer workers. And the third trend is we have a government that is putting up barriers to job creation and not giving incentives for job creation. So I think we're going to see a continued slow jobless recovery, while at the same time the underlying economy is going to do well,
so
and
what
the
do you do as an
fundamentals
investor,
are
Paul?
doing well.
Where do you put your money then?
I put my money in the stock market. I think we still got a little bit more to go on our correction, but I think this correction was needed and long overdue.
Nihilistic market.
And I think there are some real opportunities out there right now.
Meanwhile, the Dow's up 154 points at the high of day. Boy, Rick Santelli, have we set it up for you on this one, huh? I mean, is the Treasury market the only investment class that actually paid attention to that jobs report this morning?
I think so, but I think our panelists gave us a lot of clues as to the problem. The last gentleman said a jobless recovery. He's right. And then Danny Hughes said, well, the government doesn't make it easy to hire. But yet they're both bullish stocks. And here's the problem, is that I can understand a jobless recovery and I can understand a globalization process where we don't need to hire people, we still have some companies doing better. But in the end, the government is the issue. The government can't deal with all this joblessness, and their corrective measures are going to end up eating through all the dynamics that make it possible to be bullish the stock market under that scenario. The second issue is we have an eye issue. It's called blinking. The Supreme Court in Germany blinked today. The Chinese blinked, and now many think that the Fed's going to blink. That really empowers them to continue to think that the punch bowl won't only stay, but it might refill. And one last thing that really doesn't have anything to do with it, but it's important. If we look at what happened with Moody's today, 2 notches lower on Puerto Rico, following S&P on the 4th, 1 notch, both in junk territory. If you look at the MUB, the ETF for munis, it hardly noticed. If you look at a 1-year chart, it's hardly noticed. Right. But I think that this is going to be an issue to pay attention to, and especially for the distressed security guys that are going to be jumping into this to see if they can find some straw to turn into gold.
Crazy.
They might be, Patty, but what should investors do about this Puerto Rico issue?
You know,
I think I'm sorry. Go ahead.
Patty, go ahead.
Go ahead, Patty.
I was going to say, I think if you've been in Puerto Rico, you have not been paying attention to the headlines. Puerto Rico is unto itself. There are still some, we think, fantastic bargains in municipal bonds, but know the municipalities that you're buying. Don't just buy the ETF. Those don't do well in this type of a rate environment. You want to be owning the individual bonds.
Yeah,
all right,
folks.
folks.
Look, everybody's following indicators like the January barometer, the Super Bowl indicator, the AFC team won. I'm going to go with the groundhog here. You know, the groundhog didn't see its shadow. 6 more weeks of a correction.
Yeah, the groundhog didn't see its shadow because he couldn't get out.
He was dropped, the poor Pat.
Groundhog didn't see his shadow because he couldn't get out of his hole. There was too much snow on the ground.
Yeah, exactly.
Thank
6
you
more
all,
weeks of
folks.
correction.
Have a great
Thanks, guys, very
weekend.
much.
Everybody
Appreciate
watch the Olympics. Have a good time with that. So